for joining me this afternoon. For those of you who don't know, Real Estate Radio is a show dedicated to building the Washington, D.C. Metro's housing and credit markets one house at a time. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted advice. That's my message, and I will be delivering it to you guys every Monday from 2 to 3 p.m. right here on 1580 AM, The Big Talker. We've got some great topics lined up. Last week, we dived into the home affordable refinance program that Obama just pushed out there, and we had tremendous feedback from you listeners. A lot of people interested in figuring out if they qualified for the program. I'm going to dive a little bit deeper into that today with a lot of the common questions that have been coming up from last week. Also, we're going to talk about the Fed meeting that's on deck for this week and how that can affect you and your real estate decisions. Joining me on our panel to discuss these issues and many more is Louis Cammarosano, who is the general manager of HomeGain. Louis is often cited in the media as an industry expert in the Wall Street Journal, Forbes, CNN Money, Fox Business, Smart Money, MSN, and numerous others. We're going to discuss with you what happened in the markets last week, as well as what's on deck this week that can affect you and your real estate decisions. Louis, are you there?
Good morning.
Good morning, Louis.
Ryan.
Good afternoon for me and morning for you, right?
Out here on the West Coast.
How's everything going? Ready for another big week with the Fed, right?
Well, we'll see what happens.
You know, it's interesting because there's two big things that are pretty much on tap for this week in the markets that can really, sway interest rates one way or the other. The first one is obviously the Fed meeting that's this week. That's going to actually, Bernanke's going to be speaking and holding a press conference at the conclusion of the two-day meeting. And Friday, the October employment report comes out. Those two things are going to be probably the big market movers, shifting interest rates one way or the other. Last week, we had tremendous sell-offs in mortgage-backed securities, which actually pushed rates up pretty significantly. I'd say about an eighth or a quarter of a point across the board. So I really think that, what the Fed says, what their intentions are over the next couple of months is really going to continue to push interest rates. Since, an interesting fact, interest rates have increased from the 21st of September Fed meeting at which the Fed started Operation Twist, buying long-dated treasuries and mortgage-backed securities with the obvious intent to keep long-term mortgage rates low in an effort to help the housing sector. Now, Bernanke said that he expected that the twist would push the 10-year note down by about 50 basis points. Well, the problem is, Louis, it worked for about 1 day, and as of right now, the 10-year note is 30 basis points higher than the day it was when they announced Operation Twist.
Well, see, the Fed can't do everything.
No, they think that they can manipulate markets, artificially, just keep printing money and buying long-term securities. The market is obviously forward-thinking. They're pretty much seems about 10 steps ahead of where he's at all times.
Right.
Would you agree?
Rates want to and need to go higher.
Yeah.
And that's obvious, and the Fed is trying to prevent the inevitable.
Yeah, and it's just like we've been saying for the many months prior to today that, we'll have to let the market do what it's going to do. And that's going to justify the only way that, investors are really going to want to get back into the mortgage market or even maybe create, more of portfolio products or products that can be marketed on the secondary market is going to be when there's higher interest rates.
Well, but the only thing is, Ryan, this is a global issue. I don't know if you saw this morning, the dollar really should be a weak currency, and you saw the Swiss franc rise against it until the Swiss central bank intervened and drove the value of the Swiss franc down versus the dollar. And Japan went ahead and did that this morning. Yeah. They were concerned that the yen was rising too sharply, so they sold it, and they bought dollars. Now, does that mean dollars are worth more? No, the market isn't saying dollars are worth more. The Central Bank of Japan says they're worth more because they went out and bought more, not because they think dollars are worth more, but because they want to depress their currency to make their exports more. Yeah,
and really there's not that many, better options out there at this point. It seems like every country's got their own problems, and ours is just as bad. For some reason, we think that we're not going to end up in the same place as some of these other countries, which is beyond me. But I would anticipate, I believe I was one of the other Fed governors that had said that, let's see, I'm going to pull it up here just so I can give the exact quote. It was from Charles Evans, the president of the Federal Reserve Bank of Chicago, has proposed that the Fed should announce temporary boundaries for inflation and unemployment, pledging to keep short-term interest rates near zero until the unemployment rate drops below 7% from its current level above 9%, or the medium-term outlook for the rate of inflation rises above 3%. It's now somewhat below 2%, the maximum rate the Fed views as healthy. Furthermore, Given how badly we are doing on our employment mandate, we need to be willing to take a risk on inflation going modestly higher in the short run if that is a consequence of policies aimed at lowering unemployment. That's crazy to me. I mean, do we really think keeping interest rates, lower for the next 2 years is going to do anything different from what we've been doing for the previous 2?
And also, there's that false concept that somehow if you have inflation, that employment picks up.
Right. Yeah. And I mean,
so what you end up in a bad economy is you have inflation where people can't afford basic goods and services, and you still don't get job creation.
Yeah. I mean, we're going to have, obviously we've had gas and food prices rising, which is the one thing that they try to factor out when they're calculating their inflation numbers. And
half of people's budgetary allowance for their spending, right? Because if you take that's the main thing you spend on. You don't buy iPads and iPhones every week.
Yeah, and we've even talked about it. I mean, what they're doing to kind of to make people not aware of these small changes in prices, they're reducing the size of quantities in the grocery stores. You know what I mean? A package that maybe was 12 ounces is now 8 ounces and charging you the same price.
Right.
So
and they use hedonics in the system. They say, well, you're not really buying beef, you buy chicken, and chicken is still, even though it went up, is still less than the price of beef, so we have no inflation.
Yeah, and we know ultimately the printing of money, the artificial increase in the supply of money is going to lead to inflation.
Well, that is the definition of inflation.
Yep.
An increase in the money supply. I guess what we're saying is
that's the old definition. Yeah, the old real definition is what I call it.
Right.
But inevitably, we've been doing this for the past couple of years, and it's going to catch up to us. It has to. And, the one thing that we've been preaching for the last couple of weeks or months is that, the one thing that you are able to lock in is a long-term mortgage, 30-year fix to protect yourself from this future inflation.
That is a gift. If you can get that financing from a bank, I don't know why a bank would want to lend you money for 30 years at these low rates.
At 4% or lower, depending upon your qualifications. It's absolutely crazy when you think about it. I mean, every day, like I said, I'm kicking myself just because there's not programs out there that would allow me to buy 50 or 100 properties right now because I'd be doing it.
There's not a program called You Don't Have Any Money.
That's true. That is true. You're listening to Real Estate Radio. I'm your host, Ryan Sloper, joined by my guest, Louis Cammarosano, the general manager of HomeGain. We're discussing the Fed and the Fed meeting and how that's going to affect you and your real estate decisions this week. A lot of people out there are kind of confused. They're saying, well, the Fed said that they're going to hold, these key interest rates at near zero. And they assume that affects actual mortgage rates, and it doesn't. What I want to be quite clear, if you guys out there, trying to find out, how are mortgage rates, basically where are they driven from? It's actually the mortgage-backed security market, which is completely something different from the actual Fed fund rate that affects banks and what they can lend to banks, and banks can borrow money from them. What that does affect when they would raise or lower that federal fund rate is what the rates that banks are willing to pass on to you in the form of maybe credit card loans, auto loans, student loans, any type of thing like that. Doesn't necessarily affect mortgage rates. This is a very common misconception out there that people are just saying, well, the Fed's doing this, so this should affect interest rates. And obviously, most of the time, it's going in two different directions. I would suggest, you always make sure that you're reaching out to a professional that can, address and tell you what's going on in the market as we're discussing today, how the Fed meeting can affect what mortgage rates can be over the coming week. I mean, we've had a lot of turbulence. What's going on in Europe as far as Greece and Italy, that affects us here in the United States. And if you've been noticing, it's been very tumultuous over the last week or so just because of when they were trying to establish what they were going to do, how much of a haircut Greece was going to take. And now, Louis, now that we've gotten through Greece, it's now like all the market in Wall Street has now focused their attention on Italy and what they're going to do.
Exactly. Well, one point about keeping rates low, I think a lot of people have been given a false sense of security or a missed signal in the market that somehow, they can wait to buy a house because interest rates are going to stay low until, what do you say, January 2013.
Yes.
That's what they're going to do. That doesn't mean the market rates are going to remain low. Now, there is talk that they might buy mortgage-backed securities, and that might help keep rates low. Well, they're going to have to print up more money to do that, and that's going to cause more inflation. And eventually, the interest rates are going to have to catch up with the inflation.
Yeah, and it's interesting, too, because remember, QE1 was the actual Fed buying mortgage-backed securities.
Right.
And they winded that down, and then they started QE2. Mm-hmm. And then, we have Operation Twist, and now we're going to have QE3 or some form of what I think was QE1 and QE3. which was going to be probably them having to buy long-term mortgage-backed securities, because what they just did with the twist isn't proving efficient enough. So,
well, now they're going to focus on the fact that Congress can't get a jobs bill passed, and therefore the Fed has to act because that's one of their mandates. That's what they're going to focus on, and then they'll have another excuse to print money and send it into the system.
Yeah, and we've been discussing for weeks, I'm sure you guys have been tuning in, is that, instead of focusing, when Obama first got into office, really focusing on what was the problem at the forefront, which was basically employment and housing, he decided to go off and concentrate on basically the health bill. And now we're stuck a couple years later, where now he, the first 2 years of his term is done, and now he's basically campaigning for his reelection. We are stuck in this, basically, it still is a recession. Anybody that says that we're coming out of it is crazy. I still think we're in it.
That's not entirely fair to Obama, because I think the American Investment and Recovery Act was passed before health care, and I think their thinking was, when they passed that, and they were going to spend however many trillions of dollars, I think it was, I don't remember what it was a few $100 billion, that was somehow going to do the trick. And in fact, they made guarantees, pass this bill and we won't have unemployment over 8%. And that didn't turn out to be the case. And I guess they relied on their advisors that type of stimulus was going to take some time to work its way through the system. So they figured, that's taken care of. Let's go now throw our efforts at healthcare.
Yeah, I kind of agree there, but I think that there should have just been more of an emphasis. I mean, ultimately, we have the same housing issue now that we did years ago.
Oh, sure.
And I really think that if that would have been a priority, if that would have been an emphasis, if that would have been something that they would have said, look, if we can get this right, I think that we might be able to curb the unemployment, which you and I talk about all the time. You fix real estate.
The issue is that somehow the government can solve these problems. I'd say they tried. They had HAMP. They had the first-time homebuyer credit. They had a number of programs out there. So those things just don't work. They need to let the market reset. It should have reset already.
But they are, most of which were all temporary fixes to long-term
structural problems.
Yeah, exactly.
The biggest structural problem is you have too many foreclosures, and they need to be washed through the system. And a normal housing market has to come back into play. And instead, they're just trying to reheat the souffle, and it doesn't work. It extends the whole problem.
I totally agree with you there. But I think more of my problem too is that they create a program that says going to hit 5 million people, hits 900,000 people over 2 years. Right. And then since that program didn't work, they come out with a revised program that they assume is going to help 3 million people, and it's going to help 200,000 people. You know what I mean?
It's the hubris and the misguided belief that somehow the government can manipulate something as complicated as the market.
Absolutely.
And somehow they can do better. And, it's very difficult to get elected and say, well, I'm not going to do anything. I'm just going to let this work its way out. That generally is the best point of view. But when you have everybody who's got models and Keynesian economists telling you need to put this amount of money here and that amount of money there, and our model says if you do that, this is going to work, that's just fantasy.
Yep.
But it's very difficult for a politician to follow Austrian economics and just allow the market to be.
Yeah, and last week we dived into HARP, the revamped, had tons of questions after that show, obviously, Lewis. And when we come back from break, I'm going to kind of dive into what those questions are and concerns from people trying to figure out if they do qualify for this program. Unfortunately, I think that it's going to be have some lackluster results as the previous one did. If you have any questions, concerns, reach out to us at 877-245-2030. Be right back.